Welcome back to The Lifestyle Investor. This is Mike Koenigs. I'm here today with Justin Donald, and what you're about to get into are the 10 commandments of lifestyle investing. Now, one of the things that Justin's been able to do is figure out a very, very specific strategy. It's not just mindset, but also some strategies that allows him to negotiate really, really high quality deals. So what we're going to do right now is go through the 10 commandments. We're going to describe what each one is. We're going to provide an example and then also a myth. It's really a fallacy that prevents most people from moving forward. So welcome back, my friend.
Thank you. Great to be here.
All right. So we're going to go into these step by step. The first of the commandments is lifestyle first, which is each investment must truly represent passive income, where your earnings don't depend on your time spent on it. Your income is fully dependent of you and happens whether you're asleep or on vacation. So why don't we begin with the biggest myth that most people have about this that prevent them from actually taking action? Because this sounds logical, but actually having the courage and the confidence to make it true, I think is what has helped. It's actually prevented me from being able to let go of being attached to being busy and trading time for money. Even when I've had passive business interests, I still was constantly working in my business, not on it.
Yeah, well, and that's the whole, myth of time is money, and you've got to be working in your business to make more money. So that's a total myth. And in many cases, I mean, even outside of the realm of passive income, it's still not even the best protocol or value to follow inside a business. Another myth would be the whole idea of building your nest egg and living this frugal life where you can't even go to Starbucks to get your latte because you've got to save every extra penny and dollar that you can because you need a big nest egg. Both of those are total myths.
Okay, so what I'd like you to describe is, this is one of those areas where someone might say, well, it's easy for you, but at what point you had a job up till as of now about 4 years ago, and it was 21 months to reach Decamillionaire status. That's over $10 million. But in between there, when was it that you had reached enough income? Because you've got a really simple lifestyle. But what was your breaking point at where you quit your job and you felt comfortable, you replaced your income, and you could say, honey, you don't have to work, I don't have to work? What was the number that you had, and what was the investment or investments that enabled that to occur?
Yeah, so the first kind of benchmark I wanted to do was to help my wife stop working. She was a teacher, high school business teacher, and she's a great teacher, but we wanted a little bit more lifestyle and flexibility as a family. And so one of the investments that I made, she was making $36,000 a year. And so I knew what I needed to do is I needed to earn $36,000 a year from some asset that produced that income. And so in this case, we bought our first mobile home park, and I broke it down what we needed to make per month. And this first purchase covered her exact salary, a little bit more than that. And it was a very smooth transition for her to step away from teaching and spend more time with the family and travel and things that we wanted to do.
Okay, and what was the number for you at the time when you had your job? What were you earning approximately, and what did this mean in terms of like security for the monthly? Just to give everyone a relative sense on what you thought you needed and what you needed.
Yeah, well, and even before I say what I was earning, I think it's important to say that I didn't even need to cover what it was that I was earning. So I knew that our family lived somewhere between $100,000 to $120,000 a year. That's what it cost us to live. That was our current lifestyle.
Okay, so for the sake of this conversation, let's call it 10 grand a month was the magic number you felt you needed to reach. So again, I want to get into you had the mobile home park. You had the investment, and what did you invest in order to get your needs covered? So the $36K and then the 10 grand a month, just again, to create that composition.
Sure. Well, and the beauty of it is when you structure loans properly, There's all kinds of different things you can do. So instead of even just going for a conventional bank loan where maybe I'd put 20% down, and the bank would cover 80%, I actually negotiated a deal with the owner of this mobile home park to seller finance it. And so we talked about it, and he felt comfortable with me just putting 15% down, which is what I was really pushing for. I wanted to get a better deal than if I used a financial institution. And so, out of pocket cost, on the first one, it was $55,000. Is what we put down as a down payment. And then the second park was $65,000. And so both of those combined just about covered our lifestyle. With our third investment, we fully covered it. So we were pretty close with those two.
Okay, so I think this is exactly what I was looking for. Is we got into some strategy here. So you had saved $55,000. You're able to push that in, say here it is, and didn't have to touch your credit score, no banks, simple transaction, and the mobile home park started cash flowing enough income for you to pay back the loan and provide freedom for your wife. And then another one at $65,000. So really, is it fair to assume that you started your empire with about $110,000 to start with, and then things grew from there?
Yeah, and I should also say that with those two down payments, so if you think about it, I needed to replace $36,000 in income, and $55,000 did it on this particular deal. And I enter into the deals that I do where they cash flow immediately. So that first month we were cash flowing positively. But I think it's important to say that, our number to cover what we needed to cover for expenses, even though our lifestyle was $100,000 to $120,000, I mean, we could cover all of our bare minimum expenses for about $65,000, $70,000 for the year. So it was much less. So from a standpoint of just where was I mentally, knowing that, let's say that the worst possible thing happened to me, I wasn't able to work, I became handicapped or something like that. Well, I knew in the back of my mind, all right, we're covered. We can live, we can survive. We're not quite at our lifestyle that, we're accustomed to, but I at least now have the tools to be able to get there.
Great. Now, one thing I want to add here, because I've had a conversation with you, and this is more than we want to cover in this segment, but you spent some time being mentored and learning. This is one of the strategies and models that you learned, which is mobile home park investing. And you spent a good chunk of time and money and resources learning the strategy. And it's one of the things that you do when you're mentoring and working with people, both one-on-one and in a group situation as well.
Yeah, that's correct. I mean, I wouldn't be where I am today without people being willing to invest into me. But, I needed to be willing to spend the money and show up, spend the time to be totally committed to learn that education.
Okay, that's beautiful. So let's get into the next one, which is the second commandment, is reducing the risk. And that's structuring each deal to minimize risk so that a good return feels even better. It's interesting that you talk about feeling. For example, you can collateralize assets against investments such that your collateral is twice as much as the actual amount of the loan or investment. So maybe the first part is, once you talk about the common myths and the mindset behind that, and then we'll deconstruct one of your deals. Maybe it'll be the first one or another one that you use this strategy and this mindset in.
Sure. I mean, I think first and foremost, you could say the default terms are what they are, that, someone comes with terms and it's either invest in this or don't. And sure, some deals are that way. Most deals are not. So that's a big myth. Another myth I would say is that investing in general is really risky, and I really hope that this works out. Or it's so risky, or I don't know, that I just don't even get in the game, right? That's a total myth. It's not that difficult once you're educated, and additionally, it's not a, pray for the best results. I mean, there's enough due diligence that a person can do to feel really comfortable with most investments out there.
Okay. So let's, I'm going to give you a choice, which would either be deconstruct maybe the mobile home park through this lens, or if you've got another example you want to talk about, which I know in the mobile home park, you didn't go through a bank. You did owner financing, 15% down, which translated into 55 grand. They needed another deal for 65 grand. How did that fit in here? How was that collateralized? What kind of risk did you take? What was the worst case scenario when you did that deal?
So I really like this deal because with a seller finance situation, it is a non-recourse loan. So that means if I defaulted in any way, shape, or form, that the seller doesn't have the right to come after my other assets. What they get is their property back, and they get to keep the down payment. So it's still a good situation for them. They're going to make interest on this, so they act as the bank. So a lot of people like that. And then for me, I know if everything implodes and I totally screw up, that I'm not risking the rest of my assets. So first and foremost, I like seller finance deals because of the non-recourse aspect of it. But then I also like them because the terms are flexible. You don't have to go through all the underwriting that you have to go through with a bank. There are a lot of hoops that you have to jump through with banks. And when you can establish good relationships and you have good credit, they can be great helping hands. But if I can avoid them, I try to avoid them. And to get a seller that will do 5% for a 10-year note with an option to extend for another 10 years, amortized at 20 to 25 years, I mean, that is a very attractive deal. I don't have a whole lot of skin in the game. So to me, that's a real win-win.
Okay. And then all those technical terms you used right now for someone who's depending on their level of sophistication, these are things, again, you cover when you're mentoring and you're working with people as well, and when we go deeper into the content. So let's get into the next commandment, which is finding invisible deals. That's paying attention to emerging markets or unseen opportunities outside the mainstream. And that can also mean new technology innovations or companies that are currently in a reinvention. So first of all, what does that mean? And why don't you go over some of the myths and some of the things that people believe that prevent them from either thinking this way or seeing these kinds of things?
Well, here's a good one. Tried and true investments. These have worked for the last 50 years. They're always going to work.
Okay. So for example, what are some of your favorites that you've done deals in that have continued to turn out well and they were relatively easy to get involved in?
I mean, there's a number of them. If we're looking, specifically in the real estate realm, I mean, one of the things that I like to do is, for this particularly, a lot of access that I get is from the relationships that I have. And then I also like to pay attention to the trends that are going on. And so even at the rise of single family homes or SFR, single family rentals, that was not even an asset class a little over a decade ago. And so kind of being on the cutting edge of that asset class has paid dividends for investments that we've made. And, that didn't exist 50 years ago. That wasn't a thing.
All right. So one of the things that you, of course, do is, this is a shameless plug for you, but it's when people are working with you in a group or one-on-one, you've got your nose to the ground or your ears to the ground and you know what kind of deals are going on. You've got a lot of deal flow around you. But for someone who's just starting out, how did you start out? How did you find some of these invisible deals and get turned on to thinking outside the boxes?
Well, some of it's kind of reading what's going on, reading trends in the economy, what's strong, what's not strong, paying attention to the shifts that are taking place. So, for example, like e-commerce, which is really taking over the world. What a great trend to follow there. We know industrial distribution centers are going to be in demand because places need to, businesses need to store their inventory, and the most expensive cost of getting the product to the customer is that last mile or the last 10 miles, whatever it is. So that would be a new trend emerging right now. And there are tons of them if you just pay attention to kind of what's going on in the world.
Okay. So the next commandment then is getting the principal back quickly. So it's part of cash flow investing is replacing your earned income. We talked about that really in commandment number 1. And your goal is to get your money back within 1 to 3 years rather than 5 to 10, like most investments. Now, of course, very frequently when you have an opportunity presented, It might be an equity style investment where that's not possible. But one of the things that you do is you negotiate better terms, you present a different frame, or you find other ways to present value. So why don't you talk about the myths that stand in most people's way, and then a good sound example of where you've gotten your principal back quickly and how you structured that.
Well, I hear this one all the time, that it's unreasonable to expect a fast return of investment or principal. You know, that is just not what people look for, that doesn't even register, that it takes a long time and your money's going to be locked up for however long. You know, another one is that I hope that I see it, you know, in this decade, or maybe I'll never see it again, but this seems like a good investment. You know, the myths are really just a lack of education to the options that actually exist. I think there are plenty of investments where you can invest now and you may never see that principal again, or it may take a decade or longer. You got to wait till a company has some sort of a liquidation event if you're investing directly, you know, in for equity. But I think there are a lot of other ways to invest, and there are ways that you can still get equity while getting cash flow now.
Okay. Can you give an example of one of the deals that you've done where you got your principal back super quickly? Like, what kind of investment was it, and how quickly did you get it back, and how was that deal structured? Sure.
Well, I'm actually in a couple of deals right now that I haven't actually seen the principal back yet because it is a new investment. I'm probably halfway there, but both of these are supposed to be a 1-year return of principal. So one of them is in the fashion industry, buying a brand, a very well-known household brand that was sold on a fire sale, more of a liquidation type of event. And that one's going to be a 1-year return of principal, but at the same time earning a 20% return with a monthly distribution during that time frame. And then at the 1-year point in time, having a balloon payment for the return of principal.
Great. So the next commandment, the 5th commandment, is creating cash flow immediately. And the goal is to negotiate some form of cash flow on a quarterly basis, or ideally monthly. And I'll even start this with a deal that I had. And again, in the past, most of my deals were equity based. I did one recently that wasn't equity, but it was purely a loan, and I got paid 20% in quarterly installments, so 5% checks. And then what I've been doing is rolling that back into it, and that's accumulated. And it turns out this organization now, so I had no option to convert it into equity, but they recently announced that they found another way of getting lower interest loans from probably an institution because it's at a big volume. And the owner benefited from the fact that he didn't have to go through a bank, never affected his credit score, might not have been credit worthy, built his business to about 20 million. And now I'm getting all my money back, and I got to find, what am I going to put this money into? So I'm really happy I got my money out. But it would have been even better if I would have gotten some equity, so it would have continued to earn forever. So why don't you talk a little bit about how these work, what the myths of them are, and then what's one of your favorite deals, maybe something that we haven't even talked about yet.
Sure. Yeah. So, and this is another one where the myth is that the terms are the terms. Here's the deal. This is what it is. Invest at these terms. And that's just not the case most of the time, or a lot of the time. And so I always like to go back and negotiate something different. You know, whether it's just me or whether I'm bringing a group of people, where then I might have a little more influence to get even better terms. But, you know, a lot of deals where someone invests in a seed round, or like an early stage investment in a company before they're typically profitable and, you know, showing any signs of sustaining business. You might invest it for a certain amount of equity that whenever there's a liquidation event, you are paid that multiple. But most companies don't end up having that liquidation event. Most companies don't end up making it. So you may never see that ever again. But in that case, you're buying just equity. Well, I would much rather convert that into something else where I can make it more of a loan to the company, where I get equity immediately, or I get some sort of a warrant. So at the time of liquidation, I would have the right to convert to equity at that point in time. But instead of just making a direct investment, this is a loan with a repayment. So, that's something I really enjoy. I recently did a real estate deal. So this one kind of satisfies the last 2 points because my principal is supposed to be pulled out within 1 year. But even when that comes back, I have equity in the deal. So I'm getting that back. I'm receiving a preferred rate of return while they're holding my money. They're going to refi that property, and I'm going to make a percentage of the proceeds of that refinance. And then I'm going to have equity into perpetuity because this group likes to buy and hold. So I'm getting the best of all worlds and principal back quickly. But more importantly, I'm getting that equity without locking my money up and getting some cash flow today.
It's really good. So that leads us to the sixth commandment, which is finding an income amplifier. And interestingly, you talked about that, but the definition is you do this by negotiating preferred terms. You also amplify a deal by using a sidecar agreement with the direct investment. So you can maybe bring in a second investor with specialized expertise or negotiate more lucrative terms. So this is a complicated concept, but why don't you first describe what a sidecar agreement is? And then, again, go through some of the myths and perhaps another example that stacks on top of the last one.
Sure. So a sidecar agreement, so you can look at it a few different ways. So let's say, for example, I'm investing in a fund, and this fund has several deals in it. And the reason people like funds is because it eliminates or mitigates some of the risk. So if one property doesn't succeed, other properties, they can kind of balance out the total. So it's not a total loss. Maybe it's a partial loss. Maybe these other properties do so well that it totally wipes clean whatever the negative is. So a lot of people like investing in funds. And sometimes in these funds, if you get into the right fund with the right people, you can negotiate a sidecar agreement where on a particular deal, you have money in the fund that has exposure to all the deals, but there's one deal in particular you really like this. You know that market well, or the operators really well, or you just have some sort of advantage or inside info to know that this makes sense. I want to invest directly into that investment. Well, in this case, you can negotiate some more preferred returns for that investment. So you get better results on your money than if you were just in the fund. But because you're in the fund, you still get exposure to that deal. So it's kind of amplifying the results. So if you know that a deal, for me, I can look at deals and say, this one's a slam dunk. I mean, I want exposure to just this as a direct investment, and I want to be able to participate on some of the GP general partner economics of the deal for better return.
Great. Now, one of the deals that you did was with a major sports franchise. You may or may not mention who it is, but let's just say everyone would recognize this brand. So you managed to find this deal, and normally it was really hard to get to. So I'm curious, first of all, how you found it, how you came in and you negotiated an amazing sidecar opportunity in there and what that looked like.
Yeah, and so really, this one was just knowing the right people. This is me really seeing the results of many months and years of just reaching out and connecting with people. And so, in this particular deal, it was someone that I had worked with in the past, someone that had worked in one of my previous organizations under me, and I had a great relationship with him, and I had a great relationship with his wife. And so we decided to go in business. They are the ones that heard about the opportunity to invest in this company, in this organization. And they were in a position where they didn't have the funds to do it, but we had such a good relationship, and they knew that I would be a good capital partner because not only would I have the money that they needed, but I'd be able to advise them as well. And we were able to, create just a fantastic win-win situation for all parties. And we were able to get a good loan, an SBA loan at that, with a lower down payment. I think our total down payment was 17 or 18%, which is very favorable. It could actually have been 16%. I'd have to look at the paperwork. But moreover than that, I have an opportunity to advise these two great business professionals as this is their first venture. And I've had a lot of experience in investing directly into operating companies.
So good. So one of the things that I learned from you is reframing a deal or a conversation, because oftentimes the people you might be talking to may have got the investment framework from someone else, and they're not aware of all the deals that you've been exposed to. So this really points back to, in all the cases when you're describing these, first of all, earlier on when I asked you about your lifestyle, you spend so much of your time meeting with and spending time with other people, getting exposure. So it was because you had a deep relationship that you got an opportunity to invest in this deal that would have never come to you. And it's because of these relationships when you're talking to other investors, other business owners, that's where your deal flow comes from, but also the strategies that you're learning that you're able to employ. And much like now when you're mentoring other people, you're coming to folks with what could be hundreds or thousands of years of investment expertise, especially when you combine the hundreds of books you read. So I just wanted to really accent the importance of network and building this. And that really leads to how you develop your courage and your ongoing confidence. So would you just tap on how you multiply and amplify your confidence and how that fits into these last two things I described to you?
Sure. Yeah. I mean, you really become like the people that you surround yourself with and spend time with. And so, besides just meeting new people, I'm part of several investment groups as well. And I just want to meet like-minded people, but I also want to meet people that think different than I do and that play the game of life at a higher level than I do, just so that I'm constantly challenging myself to not just take the status quo, not just do what I've been doing, not just be comfortable with what I've accomplished, but to really up my game on a very regular basis, which is fun. And I mean, it's peer group that makes such a huge difference, in that part of the equation.
Great. So let's move on to the seventh commandment, which is cutting out the fat. And that is minimizing exposure to banks, financial institutions, and middlemen that charge you fees. So first of all, what are the common myths? What are the things that you had to overcome or you observe in other people who might not take this into account and ultimately profit more from it too?
Yeah, I mean, I think a big myth is that there's really just one way to invest, and you need a money manager and you need exposure to the stock market. And I'm not saying that those are bad things. I'm just saying they're not the only thing. And I think having some exposure to that is good, but I wouldn't, for myself and my family, want all my eggs in that one basket. I like to be diversified. And then I also like to have a little more control and influence on the majority of my investment. So, that one's really important. And then, in terms of just cutting out the fat, I want to cut out all middlemen to the best of my ability so that the profit then, falls on myself and my family or whoever it is I'm investing in. I would rather split that profit with them than to give it to a middleman that typically doesn't earn it. If someone earns it, I'm happy to pay it. I think that's great. I've used a lot of brokers and I'm so happy to pay that. But if I can avoid a financial institution and go with seller financing, I'm going to do that. If I can invest in a way where I don't have to pay a percentage to money managers who make money, whether I make money or not, I'd like to cut that out as well.
Great. Can you think of an example of an uncommon fat that you cut out somewhere along the line, or you may have done a deal where you didn't realize there was someone making money and they were unnecessary, and just through your education or through some connections, you saved yourself a bundle and increased or the benefits or the terms somewhere along the line, something that someone can actually look into and go, oh yeah, that's happened to me too.
Sure. Well, I mean, if you look at the fees that are paid just in general on any account of money that's being managed, you'd be surprised at what all is being charged. So for me, with my money as it was exposed to the stock market, I had someone managing it. And I just remember I had this, it was like I got punched in the gut. I looked at my statement. My statement said that I had an average rate of return that was a positive number. So I'm thinking, okay, well, that's cool. Well, I should have made some good money, right? If I have a 10% average rate of return, great, I've made money. But then when I dug in a little deeper, I actually lost money. So my actual rate of return was different than my average rate of return. So even though the average said over the last 5 years or 10 years or 7 years that I was earning a positive percentage, because that last year or a year in the middle or somewhere in there was such a bad year or down year that I lost so much during that time frame, just because the other years have a high percentage and average it out to make it look good doesn't mean I'm actually making money. So I just had this eye-opening experience where I felt like I was being lied to. I felt like I was being misled. The information made it really look like I made money. I felt totally deceived. And it was at that point where I was like, people are really looking out for themselves. And then worse than that, the person that was managing my money still made money. They could lose me money and it didn't matter. They still made money. And that just really didn't sit well with me. And that was a changing point in my life, or a turning point in my life in investing, where I said I need to take this into my own hands and get serious about it.
Yeah, and when you think about that, first of all, you said something really important. I don't mind if you make money as long as we're both making money and you're adding value. And in that particular case, think about it. Will you ever refer business to this person ever again? Would you ever consider doing business with them ever again? It's such a short game. So, well, let's move on to the 8th commandment, which is plussing the deal. And that's about deconstructing the details or details of perks and terms to negotiate the best deal. And there's always room to lower your risk or create a higher return. And that does make sense. And again, you're really, really good at reframing. But why don't you talk a little bit about how you plus the deal after you were presented with an offer and you found additional ways to earn or make money that were unusual or unique?
Well, I think the myth would again be, once you've negotiated a deal, it's kind of in place, it's in motion. But I don't look at it that way. That's a myth to me. The deal is never done until the documents are signed. And so anytime that I see an opportunity, I'd like to take advantage of that opportunity. So if I see that a company has the ability to make more concessions, or if I haven't at least attempted to ask for something that maybe I didn't think of in my first round of negotiations, I've got no qualms about asking. They can always say no, but it's interesting, when you do propose something to someone and they're in a position where they need to raise money. And, sometimes I'm investing in distressed situations, so they really need money. But oftentimes I'm investing in a situation where it's not a distressed thing, and they still they have a timeline or time frame where they need to, raise the funds in. And so often they're willing to make some concessions. So to me, a deal is constantly negotiated until I feel good with the terms, comfortable with the terms. I feel like my risk has been minimized or totally mitigated.
That's great. Okay. So the 9th commandment is using leverage to your advantage. And in some cases, financial institutions provide benefits that outweigh their fees. We've kind of gone into that. And then you also have a non-recourse loan can protect you if an investment fails, kind of like the way you set up the mobile home park. So instead of you owing the loan amount, the financial institution would simply take the asset back as its collateral. So talk a little bit more about some leverage situations and how you've used that, and if you've got another unique example of where you've invested.
Sure. Well, and this one, I think there are a number of things to consider. So when I look at this one, the number one, I guess, myth that I hear is, well, I don't have the money to invest in real estate. And that's a total myth. You don't have to have the money. What I've learned is that when you have a good enough deal, the money will show up. People want a good deal. And if you can find a good deal, it's really easy to raise money. You will have sophisticated investors that recognize, hey, this is a good deal. So I like using banks when they benefit me. And then when they don't, I like cutting them out. And so, in the instance of buying real estate, or in the instance of investing in various other assets or different types of investments, I will use a bank. Traditionally, it's going to be a recourse loan, meaning if I default for any reason, they can come after my assets. And so that one, you want to be a little more careful what you're actually signing. But in many instances, the asset itself is a high enough value that there may not be additional recourse. So those are things that I look at, and to have the leverage that a bank gives you, where you can own an asset for just 20% or 25%, which is very common in real estate. That's a great way to increase your net worth and have an asset that produces income. And then additionally, you get appreciation on that asset. You can improve the asset, so that way you can make even more money on a cash flow basis. And the whole time you've got tenants that are paying for the mortgage because it cash flows. For me, I just buy them so they cash flow day one. I don't buy anything based on the hope that they appreciate. I buy things because I know for a fact they cash flow today. And that way you can pay the mortgage down by using other people's money, the renter's money, and you can have an asset grow, and you only had to spend 25, 20%, maybe even 15% if you can negotiate a seller finance deal or find the right bank that will work with you, or you can collateralize a loan for better terms. But this way you don't spend as much money and you get an asset that's worth a lot. That's magnifying that leverage.
Right. So one thing that I hear here that's a really interesting and important way of thinking is there's a lot of people, for example, if you're doing real estate, who think that the risk is too great, where you go in and you realize, A, I can get in for no risk, negotiate better terms, because all they were doing is looking at the first offer someone made to them, which benefited only that party, not both. And you could go in and have the same exact deal, negotiate better terms that makes money with almost zero risk, and you benefit from building that asset class or that equity. So this, again, is just an ongoing mindset, and we have to remind ourselves over and over again. So let's get into the 10th commandment, the last one, which is every dollar of investment gets a return. And one of the things that you do that's really great, which is using financial, legal, and tax professionals to educate yourself so that you can recreate an investment in the future without having to pay those people to do it again. And it really summarizes a lot of these concepts all in one place. So dive into that a little bit and talk a little bit about the myths or the things that people just don't see.
Yeah, so I think a myth or maybe a limiting belief that people have is because they don't know that investment space that they can't invest in it. That's a total myth. You can learn it. In fact, once you own it, you're forced to learn it, and quickly. I found that to be the best type of learning that exists. I think a lot of people think if they're not an expert that they just can't do it, and that's a total myth. You can hire experts for everything. My team of advisors that I work with, they're infinitely smarter than I am on many different topics, and that's why I use them. That's why I'm excited to have them on my team. But one of the things for me that's a non-negotiable is when I talk to professionals, I let them know up front, I'm not hiring anyone to do the work for me solely. I'm hiring someone to educate me why you're doing what you're doing, because I want an education in this process. So I'm not just paying for the service to be done, I'm paying also for the education. And that has really benefited me. Because in a lot of deals now, I know what attorneys know or CPAs know, other experts in their field, because I've done enough deals and I've had them walk me through it. So I might not have to pay as much in the future. Additionally, because I can do a lot of it myself, I might only need less of their time. So it discounts, that legal bill.
It's very good. So I think the best way to wrap this segment up is, first of all, if you haven't done it already, and maybe one of the ways that you heard about Justin in the first place was from the original video or article that showed up in Entrepreneur Magazine or MSN or Forbes or Yahoo, for example. But in there, you'll get a little bit more and some other nuances of how the 10 Commandments work. And know that these are concepts, they're core ideas that Justin has developed after investing hundreds of thousands, actually risking millions of dollars and investing millions of dollars, reading over 1,000 books on mindset, money, investing, and also belonging to dozens of groups and seeing thousands of deals. So you're getting all these summarized in one place. And what is important at this point is if you want to have more access to Justin and his brain, definitely look at the other videos that we prepared for you. One of them is about getting mentored by Justin one-on-one or joining his group. And in the next video, what you're going to learn are some core ideas. So if you were going to start out from scratch and you had a fixed number of or fixed amount of money that you had to invest or risk, you're going to hear Justin's strategy on what to do next and how you can take advantage of the mindset as well. No matter where you are, if you're a rank beginner or you're an advanced investor and you want to use some of these techniques and strategies for yourself. So thanks for watching. We'll see you in the next video.